Hi, Sir Parag Sam. Welcome to this live webinar. We're looking today at when residency becomes a tax residency for expats. We're in the middle of a residency series, which you can follow on up by subscribing to our YouTube channel here for living and working abroad, where we're looking at a residency issue and more ostensibly when residence becomes a tax residence. That's what we're looking at today. So we understand that we can stay in a country, and in many countries we can stay visa free for a period of time, but that will at some point become tax residency. So tax residency starts at 183 days, and that becomes a key. And we've been taking a deeper dive into 2023. The EU Schengen Zone is adopting an electronic travel authority system, the ETIAS, that will come into force throughout not just the EU but also the EEA, and that will effectively allow governments across border to limit people to the Schengen short stay rule, which is 90 days in 180. So we're going to look at today more about what that 90-day rule is in an international perspective, and also what the implications are with Schengen, as well as look at some options around the world, looking at different places outside the EU. What does it take to be a tax resident? Well, we've got a download available on our website. I've got a copy of it behind me. When a tax residency is being determined, what the tax office of the country that is making the assessment is looking at is where your permanent home. My Wi-Fi went awry there, so sorry about that. Hopefully we're very smooth. So what we're saying is that tax residency is dependent upon you having a permanent home in that location, which means that you need to be able to stay for effectively for a full year. The second thing is what about your vital interests? Where is your wealth coming from? So if you're working, if you're living and working abroad, so where is that work done? So you might try to claim that you're living in Monaco to not pay tax, but if all the work is being done in another country, the country can hold you to account to pay tax in that location. But what is your lifestyle as well? Creating an offshore company or a nomad lifestyle gives rise to a pattern. So where are you based most of the time? Are you in one country more than 183 days, and hence a tax resident in that country? And finally, if the tax officers that are looking at that can't make a decision on any of those rules, they'll look at your nationality. So if you're a UK expat living and working abroad, you're UK domiciled, that will be your default tax residency if you're not resident somewhere else. So a nomad, whether they're German, French, British, or any other jurisdiction, will need to have a tax residency somewhere else with a double taxation treaty in order to enjoy a tax residency in that other country. Otherwise, their home country becomes the default tax status. Now, some countries like Germany, very hard to let people go. Other countries will let people go as tax residents more easily, but they will keep a record, check up, and an expat could find themselves going home after 5, 10, 15 years abroad to a large tax bill. Partnership can help you with that, give you advice and guidance. We've got our residency series. If you subscribe to our YouTube channel here, or contact us at partnership.com, well, our website looks for help and guidance for expats living and working abroad across border, as well as down generations. So let's have a look at a bit more detail now about what residency means in the EU Schengen Zone. So in the EU Schengen Zone, they've encapsulated within a legal framework the short stay rules. Under international law, a 90-day trip to any country is ostensibly allowed without visa travel. Now, some countries still require a visa before that 90 days, but generally, 90 days travel without a formal visa stamp is allowed to most countries around the world. In the EU Schengen Zone, that's formalised for tax security, so that you can only spend 90 days in 180 days in that country. Now, the EU Schengen Zone is the EU countries, including Croatia now from the start of 2023, but not including Ireland, Bulgaria and Romania, and Cyprus. Bulgaria, Romania, and Cyprus have applied to join, but they're not members yet. It may be this year, it may be next year. With the introduction of the Electronic Travel Authority, there's a clear deadline that would help the EU's process to get them in the Schengen Zone by the time of the Electronic Travel Authorities introduced in 2023. Ireland have not applied to join that, and so there's some slightly different rules looking at Ireland, and we'll compare those later in this talk. If you're an EU citizen traveling around the Schengen Zone, you don't need a visa, and you're not bound within the EU countries, within the EU, to the 90 in 180 day rules. So an EU citizen has got freedom of movement without a passport throughout the EU and can stay more than 90 days in 180 in any of those countries. EEA citizens have got that freedom, but there's to travel, but they're constrained to the 90 and 180 days within those EU Schengen Zone countries. So something to bear in mind there, there's a distinct difference on that. Looking at Ireland, Ireland is a member of the EU, but it's not a member of the Schengen Zone and hasn't applied to join, but it generally applies EU rules on resident permits where you can stay for 90 days. If you want to stay for longer than 90 days, you can do, but you have to apply for a residency permit to do that. So it's fairly easy to get one for more than 90 days, up to 12 months in Ireland, and you can apply for that, but you need to apply for it before you get there, because they do use the short stay rules, which are within the EU framework, which makes Cyprus quite distinct. The Schengen Zone rules make it very difficult for you to become a tax resident, but it makes it very difficult if you're working to stay longer periods in one country. It doesn't mean to say that you can't have two homes in two countries and spend 90 days in Spain and then 90 days in Portugal, 90 days in Greece and then 90 days in France. So these things are possible if you've got that dynamic. Let's have a look at some countries where you've actually got the freedom of movement to stay in it for 180 days. If you stay 180 days in a country, you can be resident, but not tax resident. But that depends upon what your visa requirements are. If you want to stay more than 90 days, not all countries allow that. But if you consider Panama and Mexico, those are two countries where you can enter the country and stay up to 180 days without a need for any permit or residency visa. Colombia is the same, and for 90 days, as is Ecuador, but they don't apply restrictions in the 90 in 180. So if you're in Ecuador, Panama, or Colombia, you can cross the border just for a day or more into the next country. Cross from Ecuador to Colombia, for example, to stay for 180 days, to spend a 6-month period in that place. But beyond that, you then becoming to get involved in tax residency. Countries like Hong Kong, you can stay for 180 days without an entry visa, without a residency permit. So they will let you in visa free to stay up. The UK is not the same as that in the past, but that is, and if you want to stay more than 90 days in the UK, apply for permission to stay up to 12 months. So that's a resident permit to stay, not a visa, and it's generally freely available. So if you want to stay more than 90 days, and you can do that once you're in the UK, but you can extend your stay beyond 90 days. With Cyprus, Cyprus is not in the Schengen zone, but it is in the EU. So like Ireland, it applies the EU principles that once you've been in the country for 90 days, you should apply for a residency permit. The interesting thing about Cyprus is that the residency permit involves a face-to-face interview. It's not all online, and it might take 3 to 6 months to get that sorted out. But as long as you've applied for that, you can then remain resident for the 6 months or beyond. But you can't become a tax resident until you've got a permanent permission to stay in any country. When you go to a country in Indonesia, you need you can have a single visitor visa for a period of 60 to 180 days to go and stay in Indonesia, as any sort of visitor visa is what's available. If you want to stay longer in Indonesia, then you would have to have a sponsor for that. And with residency visas, it's often the case that you need to have a local sponsor, or which could be an employer, a family member, or some other work-related activity. Let's now look briefly at some 90-day countries where you don't have a great deal of issues, and then I'll come back to a question that we've just been asked. So as I mentioned before, with Ecuador and Colombia, you can freely enter the country without a visa, for the 90-day stay, but it's simple, without restriction, to be able to cross a border and come back again within a day or two to extend your stay to the 80 days. Visiting a country like the Seychelles, again, you can visit it for 90 days, but they won't impose any restrictions beyond that to restrict you when you're going out. But if you do maintain your residency beyond 6 months, then you're beginning to become a tax resident. Malaysia as well, you can have multiple visits and multiple stays on the 90-day period. But bearing in mind that you can't do this with the EU Schengen Zone. So in countries like Malaysia, you can visit and leave and come back for multiple 90-day stays without restriction. In the Schengen Zone, in the EU, it's 90 days and 180, which is measured at the border with the passport checks and with penalties available, which might stop future entry into the country or an on-the-spot fine for that. So consider that. Your ties to a country, for what we're talking about here, we're talking about residency, short-term residency and longer-term residency isn't an issue. If you're a citizen already or a national, then you've already got a right of entry into that country. So we're talking about people that are entering into the EU or entering into a country that are not from that country or from that block of countries. And then the 90-day or the residency rules and the residency permits become more significant. To become a tax resident, like we said, you need to have a permanent residency, so that the short stay is allowed without you becoming a permanent resident, so you can't be held to be a tax resident. But if you do that, then your nationality will dictate where your tax resident is. So if you're a nomad that's living and working abroad, or you've overseas property and you use it for long-term stays in another jurisdiction, you have restrictions on the time you can spend. One solution might be a residency permit to come and go for longer periods of time. Another solution might be to get a resident permit and tax residency in that jurisdiction. The best place for your tax residency depends upon where your income is coming from as well. But if you want to relocate and be an expat and enjoy a lower rate of tax on your business or savings, you can contact us at proactpartnership.com to give you that extra advice. Thanks very much for listening. We'll see you next time.